Hello, active traders, and welcome to our Trading Week Ahead broadcast for today, Saturday, May 23rd. Happy Memorial Day weekend. A reminder, markets are closed Monday, so we get that extra day to sleep in a little bit. As always, all information presented today is for educational use only. Not making advice about what to buy, sell, or hold, and by what's this, we do not make actual trades. It's all for learning. Now, for more, be sure that you do register for my live trading room experience. I've run it now for 20 years. I first started running it 20 years ago at tradingtheopen.com. We get daily classes and walkthroughs step by step of specific breakouts, like BJ did great yesterday for us, right? Anyway, we've got really good step-by-step training and answer questions and really good positive, energetic, intelligent coaching environment for active day and swing traders. I do a lot of expanded swing trade as well as intraday open range breakout day trades and gap runners and the rest of it. So do try trading the open. We've got a substantial number of new subscribers in this last couple of months, so it's great to see so many new members on board as well. Okay, so what's going on with the market, gang? Our S&P looks relatively strong. You can see it's hovering near the 3,000 key resistance area on the 200 SMA. What I don't like about this market is how flat the candles have been the last 5 days. It's been relatively subdued price action in the market internals as they're trying to digest the Monday gap gain. It really never did move off the button from Monday. So last week was a gap up Monday, sideways all week market. It was not a best week ever and blah, blah, blah. It was a gap up on Monday, then sideways as heck market. There's a few things to be aware of moving forward, or a few ways to plan for market volatility. The first is always think about if then. So if the market breaks 3,000, then what? Well, we'll get a blow off top. I would expect a false breakout unless we see a minimum 3-day move over 3,000. So that's the key strategic tip. Because the lack of enthusiasm of buyers this last week, the market may be slowing down and may be ready for a pullback or drop next week too. So I'm both long the market in individual instruments, like I'm long PIN, PENN, and others that are running up, but I'm also short the market by being in some of the inverse ETFs like SQQQ and TVIX and whatnot to go up when the market drops. Anyway, on the playbook is we could get the simple breakout continuation run. That'd be the best case for the bulls. So it finally breaks over 3,000, never looks back and keeps going up. I would deem that not extremely likely. What's more likely is you'll get a false breakout and then a pullback or head fake into the range and do a mean reversion pivot down to 2850 and then consolidate for a bit and then probably lift up again. And then it's anybody's call from there. We don't predict, we react. So with that in mind, I want you to develop a trading plan based on what happens if the market does break 3,000. What are you going to do? Obviously, you want to focus on the strongest sectors. Currently, that being our gaming stocks and cannabis stocks are the two strongest sectors. I'm currently long both of those. For example, I'm in PENN, which has been really good. I've been in for quite a few weeks, and it's gone up a long ways for me. So it's one of my best holdings for swing trade. Anyway, or what happens if we get the false breakout? The way to tell, or what you want to look at, is the day after it breaks 3,000. If it does, what's the next step? What's the next episode of the story of the S&P? So anyway, that's really important. We have flat candles telling us we don't have a lot of buying pressure lately. It's slowing down a little bit, but we are at a key resistance level at the 3,000. The other thing to follow hand in hand with the S&P is obviously going to be your VIX. And as you follow the SIBO Volatility Index, what you want to look for is either a recovery of the 100 SMA over, say, 35 or so, right here, or a drop under 25. It's been in consolidation the last week or two. If we get a bounce over 35 or so, that may be a sign that the bears are back and we may see some market selling. So do pay close attention to the VIX along with the S&P. Always helpful to check in with a couple of recent sector charts, and a couple we've been following lately have been the semiconductors as well as the DRG, which is our pharmaceuticals. What do you notice about the pharmaceutical sector chart? Are the buyers aggressively buying pharmaceutical stocks in this index? No, they're not. It's been a flat congestion box for all of May. So that means despite individual instruments like Novavax, Moderna, or whatever running on coronavirus news, that has not been shared by the instruments in the pharmaceutical sector. So it's slowed down. That's a sign for bearish reversal. All right. That's not a sign to go out and buy the pharmaceuticals. This is a time to take profit in pharmaceuticals. Semiconductors, on the other hand, have continued to stair-step their way up. So in a coronavirus world, tech has been an especially strong sector. And whether you're looking at Zoom or Citrix for that matter, or any of the stay-at-home friendly sectors, things like semiconductors. Now the thing that would scotch this, that would put a dent, a headwind in semiconductors, would be continued trade war with China escalation, which looks like we're headed that way. So I would absolutely, or I'm not going to be buying any semiconductors at all up here because I think it may be due for a pullback or reversal. Now, in terms of hot sectors, things like pot stocks have been up. There was a recent article about something about it helps block receptors, helping therefore protect against coronavirus, some study up in Alberta, and you can Google that, but that led to a big spike up in Thursday's market on the pot stocks like Corona, like Canopy Growth, and Tilray and others. So do keep an eye on the pot stocks or the casino stocks, pot stocks and the casino stocks. Novavax has been one that's been in the headlines. Obviously, this would not be a good candidate for a swing trade. It's been fine for day trading, at least what we've seen in terms of market volatility, but I wouldn't touch this guy because it's been under 4 days of sell pressure after the gap up on Monday, and it may well drop back down to 36 or lower. So day trading at over 50 is fine. Swing trading and not so much. I'll be buying Canopy on a breakout. I've traded this since mid-March and mid to late March, and I will trade it again if it gets over that 20 level. ACB's kind of been an up and down story, eh? Aurora Cannabis back on, what was that, Tuesday, right? Did a really big update. Monday and Tuesday was up. Monday, Tuesday, Wednesday, Thursday, Friday. Monday it was up. Tuesday was down big. Wednesday flat. Thursday, Friday kind of flat. But hey, if it gets over 20, you might want to follow ACB for a continuation run. It had been much higher and it's benefited from the good news. Ones that you want to day but not swing trade are things like this, SRNE. This is really good for us back, it was a week ago Friday, right? Big move up on Friday, and ever since then it had progressive down moves. So maybe worth a shot if it breaks back over 6 because of the volatility, right? Good runner. One thing you don't want to be on the wrong side of is charts like Codex, right? This one had a big move up week before last, but then it crashed and went sideways ever since. So don't be too enthusiastic. My point is, don't be too enthusiastic if you're in a big winner that runs up. From a trading strategy note, what I found, at least in my own trades I've been doing this past week, is trailing stops are really critical, right? I use trailing stops. I use a blend of both trailing and hard stops. And I think when you're looking for trade setups, it makes sense to experiment with both trailing and hard stops, whether you're day or swing trading. You really want to focus on how to manage risk and also how to lock in profits, because in this kind of market we get several patterns. The most common one is a mean reversion, where something will run up or gap up and then fill to 50% or so and then grind sideways. So that's one pattern to be aware of. And the other is the pop and drop type of pattern. So let's do a quick technical exercise because we got a few minutes left here. I'm going to buy Canopy Growth if it gets over 20. Absolutely. Now it's probably going to, if it does some big ass gap up to 22 or something like that on Monday, I'm going to leave it alone. But if it slowly grinds up over 20, let's say gaps to 1980 or something, I'll initiate a small trade at say 20.3. Where would you trail a hard stop if you entered 20.3 for a swing trade in Canopy Growth? Just a quick activity. Alexa, play theme song from Jeopardy. Okay, wake the blank up, everybody. Ding, ding, ding. This is where you type in an answer. Let's say you buy Canopy Growth, which is probably not a bad idea if it breaks 20.3. Johnny, tell them what they won. Contestants, at your keyboards, type in an answer. Let's say you buy 100 shares at 20.3. Where the blank? Where the fudge? Shut the front door. Where are you going to trail a hard stop? Where are you going to set your initial stop loss, I should say, in Canopy Growth? Let's say you're just doing 100, 200, 300 shares. Little chicken shit trade. You're not doing some baller 5,000 shares or anything. Doing 50, 100 shares. All right, thanks, Frank, Andrew, Mira, Mukesh, other Frank, Damon, Ed, Phil. Yes, your time is up, gang. William, Eric, Tim, Jim, Andrew, Murray, John, Gerald, Bill. Lots of answers. 1908, 1935, 18, 1994, 18 and a quarter, 1950, 1975, 1907, 1955, 1909, 1907. And thanks, Bill, for the heads up on Canopy After Hours. Yeah, the correct answer, what I would use would be 19 even for a swing trade. Now, if I'm doing a day trade, that'd be another story. I'd use like 1980 or something, but 19 even whole number. If you buy somewhere right, say between 20 and 20 and a half, the hard stop would be 19. It would not be 17 or 16 or 15. And thankfully, none of you posted that. You guys are all in the 19s or at least 18 and up. Yeah, 18 is fine, 19 is better, but somewhere up in that little pocket range. That's one of the neat things about using your 100 and your 100 estimates technical support, but we're not going to give it that much range. But it did break above that level, so I put it on my radar. Last time I tried to fake out, didn't break over it. Actually, technically, that formed the line here, or partly responsible for forming the line there. But yeah, anyway, so if we buy somewhere north of 20, we use a relatively tight stop. I would use no lower than 19 for the stop. On the flip side of that, let me ask another question. My most successful trades that I've made the most money in, or many of them at least, have been ones in which I've scaled in. So I start small, like I'll probably buy just, knowing me, I'll probably just buy 30 shares. That's what I normally start, $500-600 worth of an instrument. So I'll buy 30 shares there. And that way, if it bites me in the butt and goes down to 19, that's not going to cost me more than $50. So that's a cheap entry, right? But the more important question is, where do you scale? So let me ask, you can get more sophisticated with it, but where would you position size into Canopy Growth? Where would you add more shares? Where would you double down? At what price point would you add? Give it some thought. But let's say, and again, it all depends on the initial share size. Let's say you buy 50 shares, 50 shares, just $1,000 worth, 50 shares at say 20.3. Where would you scale in? And a hint, you don't want to scale in too soon, because once you scale in, and I've taught this for decades or at least many, many years, once you do an add-on trade, you need to then pull up your stop to break even. So for example, if you bought 20.3 and 21.3, 21.3 would be really too tight because it only gives it, 50 cents of wiggle room, and on a swing trade, that's too tight, you'll get shaken out. So it's kind of a delicate balance between getting shaken out of the trade and scaling in a way that makes you more money. And you should expect that you want to have more of the house's money to play with to survive pullbacks, because once you put on that second trade, you've absolutely got to, and I always use 100%. I don't scale out in increments. If I buy a 20.3 and I buy up higher, I'm going to put in a trailing stop at break even midway between the first and the second entry on all shares. Now, frequently it'll break out, and maybe you bought the top in it, and that's fine. It's no big deal. Happens all the time. The key is the top blows off, it pulls back, and then if it resumes the trend, you want to keep that trade alive. keep the trade alive. And so the way to do that is to not scale too soon. So you've got a bigger latitude of house's money to play with. A lot of good answers. I see 22, 22.30, 22, 2-day over 20, 21.75. No, I'm saying if you buy 20.3, it would be your secondary. Let's see, Andrew, Frank, Bill, Mukesh, John. 22.40. That'd be the earliest. If you're playing real small size, 22.40 or so. But I'd want to give this guy, normally we use 2 points. And so if you buy 20.30, 22.30, makes sense from a 2-point rule. But you might want to give it even up to, say, 24. Again, it depends on the size. I don't have time to go into the details, but if you're trading small size, you can trade a little more aggressively. So 20.3 and again 22.30, that makes sense. If you're doing, say, 30, 40, 50, 100 shares. But if you're doing larger size, like 200, 300, 500 shares, some block trade, you might want to wait for it to break over 24, and that gives you 2 points of pullback. So if you buy, say, 20.3 and you buy again at 24.30, that gives you the latitude of 2 points of pullback range after the second trade for it to stay alive in this region and keep running. Now, a quick tip. One thing that's, I guess, psychologically and financially makes sense to do is, rather than a break-even exit, you might want to do break-even plus on the pair. Even if the first trade was the win and the second trade was the stop, you still get paid on the pair. So do a lot of thinking, and again, you need to do position sizing only in trending instruments, right? You want to find something that's got a multi-day uptrend, like Canopy Growth. You don't want to scale in the first sign of a breakout, because oftentimes that's a false breakout, and that's frustrating, right? So what you want to do is develop a sequence of trades designed to capitalize on ongoing price volatility. So if we buy somewhere over 20.3, small size you can have at it sooner, large size you'd want to have at it later. That kind of conditional thinking is really important when you're trying to develop a trading strategy that's robust, and with the goal for it to be consistent, you've got to use absolutely critical, well-developed risk management, and I always follow rules. For example, charts like Canopy Growth that have a dynamic uptrend of several days, which this one has, make sense to trade. Now, I don't buy nines, and that's why I didn't buy it yesterday, because I have a rule that I don't buy anything with a 9 in it with the expectation that if it's going to stall out, it'll do so somewhere right near 20. Because if you'd been in it from earlier, a 9 would be a good exit. So it'd be good to sell into the buyers yesterday. Be good to enter again somewhere north of 20. So look for, traders have asked me for decades, how do I get more consistency in my trades? And a big piece of that is trading consistent charts that have good well-developed uptrends. Some of the charts that are haphazard or range-bound or risky, you want to stay clear of for swing trades. Like, for example, this one would be completely unsuitable for a swing trade. So would ACB, because it's gotten kind of rich lately. Right? It had been at 12, 13, now up at 17. Now it makes sense to take a shot if it breaks over the 18, but you want to play it safe, right? So often you see this pattern, you get a parabolic breakout, kind of a pop and drop, mean reversion pullback, it's back alive. ACB also may be worth taking a shot at somewhere over 20, but this is not nearly as good a chart from a risk management standpoint, in my humble opinion, than is Canopy Growth, because the range is extreme from 6 to 18. It's tripled in just a week. So keep that in mind. There's a lot of downside risk to this guy too. If there's some negative news, and the market just happens to have an off day, the takeaway, what I'm trying to communicate is you don't want to swing trade instruments that have really big ranges, except with extremely small share size. And it's better to trade relatively well-developed trending instruments. So that's a breakout that's worth a shot over 20, sure. But of the two, I'm going to focus my energy on Canopy because it's got a nice, 7-day uptrend that's got a stair step that doesn't have a pop and drop pattern. It's been consistently bought up from the 13, 14 lows up to the current right over 19 level. So anyway, that's just some bonus thoughts there and some tips for the week. I wanted to wish you all the very best for a successful week ahead. Just a reminder, if we take a look at broad markets, and I mentioned this yesterday, the S&P is in a relatively sideways congestion box. So you want to wait and see if it breaks over 3,000 and expect the worst. Always expect a false breakout. It keeps you out of, potentially can keep you out of trouble as a trader. Always expect it's going to screw you over. It's going to take out the 3,000 and get the newbies in. 3020 would be a smarter trading resistance level for the S&P, by the way. Just take note of that. If I were making a call on the market itself, I'd go long over 3020. 3,000 is the obvious dumb money resistance. And the market makers, it's not paranoia if they really are out to get you. And they are really out to get you and separate you from your capital. So do expect the old fake out if we do break out over the 3,000. The only thing that would tell me that the breakout is likely to continue is if we have at least 3 days or more continuous move up. If we hold over 3,000 for 3 days or more, okay, then the bulls are in charge, likely. But the first sign of a breakout is not, I don't want you to get on this edge. Well, I'm not going to get on the edge of my seat and, hey, the market's running up. It finally broke 3,000. Let's have at it. Because often that's the place where, that's the exact spot where professionals are selling to amateurs, right? Is the false breakout. So expect a false breakout. Plan for it. And next week, if we see it did exactly what I said, and I say I told you so, as I often do, in a nice way, in a pleasant way, I want to prepare you for the upcoming volatility in the market and play it like a professional, not like an amateur. An amateur would buy the first sign of a breakout over 3,000 and then be really pissed off when it drops down to 2,800 and they take big stops and say, how did it happen? It looked like it was going up. Professionals are like, hey, let me sell to you if it breaks out over 3,000 because that's a good place to start taking profit. So definitely get what's called a blow off top, right? So do be prepared for several outcomes. We could get the bull run. We could get a gap and go. It gaps up and it runs continuously up and never looks back. That's possible, but unlikely, I think. I think in this range-bound market, we're likely to see more range. It might be like a Darvas box. We're in a trading range. We might cycle into a new range to the upside. We also might, this might be the top and market may drop from here. So be ready for a fake out to the upside, a continuous run to the upside, but also be ready for a drop back down into the channel that we've been in with the 2750 level as support. Anyway, that's it, gang. Thanks for being here. Appreciate it. Hey, Fernando. Let's see. Right, TJ, right. Because the market's algorithmically driven, try and say that 3 times fast. Algos are in charge. I can't help but think of Skynet from Terminator, right? The algorithm's in charge of the market. And hasta la vista, baby. I'll be back. You want to play it safe. All right, well, I'm going to run. I've got swing sands coming up. You guys have a safe weekend. Happy Memorial Day. And, a thoughtful holiday. I lived here in a military town in Colorado Springs. A good time to remember those who've done well for us. And remember, markets are closed Monday, so take Monday off from the markets. There won't be much going on. And I'll see you guys next week. And again, do join my live room at tradingtheopen.com if you want Monday through Friday morning coverage. It's really popular for a good reason. That's why I've been offering it, running it for just over 20 years now, from the year 2000. So www.tradingtheopen.com. Anyway, take care and best wishes for success. See you guys next time. Let me put that final parting, the popular slide. If you haven't yet done a trial, you can get 3 weeks of the live room for just $7 via PayPal. If you stick around, it's only $197 a month, and that gives you over 30 hours of live market training with me personally and answers to your questions all month long. So anyway, do consider it, and I will see you guys next time. Thanks so much for your loyalty and for being here. I appreciate it.